In this video, traders are going to look at how do spread betting prices change. Stay tuned. Hey guys, warm welcome to you. Alright, so spread betting is a tax-free wrapper for most people anyway, and tax laws can change and all that kind of stuff, but it's a kind of betting wrapper to speculate on the direction of financial instruments like crude oil, like shares, like stocks, like commodities, like indices, and some cryptocurrencies as well. So how do spread bettors come up with their prices, and how do they change, or what makes them change? So spread betting generally is tied to an underlying. Now some slight differences we'll look at in a moment in the end, but for all intents and purposes the price will follow an underlying asset, and the underlying really means what the actual market is. So let's say for example they were quoting you a spread betting price in Apple, the stock Apple. The underlying would be actually Apple trading on the exchange. Same with crude oil. If they were giving you a price on crude oil, the underlying would be whatever front month contract was on the exchange, or a mixture of the front month and the far months, and that's where we get slightly different. But there's an underlying asset that's actually traded on the exchange where the spread betting price is derived from. Sometimes it's direct in the case of Apple, and we'll show you that in a second. Sometimes slightly indirect, but ultimately it's still the same kind of thing. So let's have a look at this example. So imagine this was a stock. Okay, here's the underlying market. Let's say this was the NYSE, so you're trading in an American stock, and it's sitting there, and its bid is 2015 and its offer or its ask is 2016. So you went to the exchange, you'd pay 2016 if you were buying at $20.16, and if you were selling some shares you'd get $20.15 just at the market right now. However, spread betting company, of course, they have to make money, they need to make money from you, and this is their model. So their model would be to add a spread onto both sides of the market. So the underlying, i.e. the market there on the NYSE, is $20.16. They might add, let's say, 3 cents to that. So it'd be $20.19. And the bid, $20.15. The bid would be $20.13. So in this case, example, they're adding 3 cents either side. So that's how they're making their money. They're making their money from the difference between the two. And in theory, they hope that maybe a lot of people will go long Apple, a lot of people will go short Apple, or short this stock, whatever stock this may be, and they're going to make that difference in between. But if not, then they can still go out and hedge that exposure and still make a little bit of money on that trade. If you just came out and bought a massive amount with them, they could buy at 16, sell it back to you at 19, then making a little bit of a spread for all their stuff they've got to do. Now, of course, don't forget, with spread betting, there's no commission to pay. You pay it, the commission, if you like, or the costs are wrapped up into the spread. Whereas if you're trading directly on the exchange, you're going to have to pay a commission on top of the price and some exchange fees and other little bits and pieces. So actually, you might end up paying $20.17 or $20.18 by the time you factor everything in. So it's not necessarily expensive as such. It's actually and a lot of instruments are actually, believe it or not, are cheaper to spread bet. Some of the indices like the DAX and the FTSE, and some of them if they've got a tight spread. And again, check out our broker in the link in the description below if you want to check one out that we like. But some of the spreads are so tight, they're actually cheaper than going to the exchange. And that's just because they've got loads of volume on one side and the other side, and they're making a market in the middle, and they're middleman, and they can afford to have the tight spread because they've got so much volume and flow going on both sides of it. They don't really need to go to the exchange. So that's how the price is made. So what happens, how does the price change? Well, the price changed when the underlying market that's just following, or the price is based on, moves up or down. So in this example, the price goes up. People are buying on the exchange, that's causing the price to go higher. And now, let's say 10 minutes later, the price is $20.17 bid, $20.18 ask. That will then automatically move the spread betting price, and as soon as they've got the same pricing model, as in adding 3 cents to the ask and taking 3 cents away from the bid, that's going to sit there at $20.14, $20.21. So if you want to buy it now, you have to pay that. If you want to sell it now, you'd have to pay that. And that's how they'd work. And that's why these platforms are so good, and why technology now makes it so useful, is because pricing used to be you'd have to wait and get a price back because they'd have to go on the exchange and they'd have to offer you a price. Now, obviously, they're just taking that data, they're automatically updating their prices in real time for the thousands of instruments they offer, which means you can get immediate access to all these markets instantly at the click of a button. So they're making prices instantly, fractions of a second they're updating new prices, and when you're placing a trade, you're getting a confirmation instantly as well. So technology is great now for spread betting. It's become so easy and convenient to spread bet, and in that tax-free wrapper, which makes it a really useful vehicle for short-term traders, specifically if you're based in the UK. Like I say, check out the one we've got in the description, link below. Otherwise, I'll link in the description below, should I say. And whatever you're doing, guys, keep your risk managed if you're deciding to spread bet. And if you like this kind of stuff and you're interested in spread betting, trading risk and stuff, hit the subscribe button for more videos from me and others on the channel. Take care. Bye-bye.